Well, good evening. Welcome to our evening course or class on fundamental analysis. As I joked, to say you're a fundamentalist does not mean you're a member of the religious right. To say you're a fundamentalist means you like to either do test question 65, 66, top-down analysis, where we make a decision about the economy, the industry, and then the stock, or we're going to be doing bottom-up fundamental analysis, where we start with the company, the industry, and then the economy. Since we're looking here at a particular company called ABC, we would be doing what we call bottom up. And here we're looking, when fundamental analysis, looking for a good value. We're looking for a margin of safety in terms of buying the company's stock, ABC. Recently Charlie Munger passed on, and he was the partner of Warren Buffett. And they asked Mr. Buffett what he learned from Charlie Munger. And I always think of fundamental analysis. I think of Mr. Buffett. And he said that Charlie told me that I shouldn't be so worried about getting a good value that I'm not buying good companies. I should pay a little higher price, perhaps, and buy better companies than I otherwise might. I thought, well, that's kind of interesting if you could teach Mr. Buffett something. This is testable on two levels. It's testable as it relates to doing what we're doing tonight, fundamental analysis, but it's also testable in terms of a client. Let's go know your client. I say, for me to do a really good job for you over time, I need to know a lot about you. The more I know about you, the better I'm going to be in determining suitability. One thing I'd like to take is a snapshot of where we're at today financially. A balance sheet is a snapshot in time. Could you tell me about your current assets, cash, or things you plan to turn to cash within the next 12 months? Could you tell me about your long-term assets? Your house, your car, your retirement plans. Could you tell me about your current liabilities, things you need to pay within the next 12 months? Could you tell me about your long-term liabilities, your mortgage, your car payment? What I'd like to do is establish your net worth as of today, June 20th, 1994. Now, it's called a balance sheet because it balances, right? The classical balance sheet equation, very testable. The classical balance sheet equation is assets equals liabilities plus net worth, known as shareholder equity. I always struggle with the classical balance sheet equation. And the reason I struggle is because I think of it as assets minus liabilities equals net worth. That's the fun thing about math, right? Mathematically, that's the same thing to say that assets equals liabilities plus net worth. That's the same thing as saying mathematically that assets minus liabilities equals net worth, shareholder equity. And that's why it's called a balance sheet. As we see here, both parts of the balance sheet do indeed balance. All right, so let's go over some of these accounts that ledger entries, these are called ledger entries, not testable, that we're going to be looking at in this particular balance sheet this evening. So current assets are cash or things you plan to turn to cash within the next 12 months, right? It's embarrassing, but the older I get, the more liquid I like to be. I don't know why. It makes me feel good. My friends make fun of me, that I carry around a wad of a bunch of money, cash, $100 bills. I always joke, they make fun of me until they need some money. Then they know that, hey, Dean has some liquidity, right? Again, kind of lazy. People I do business with, I don't bill them every month just because I don't want to do it. I just bill them at the end of the quarter. So, right now my accounts receivable are about $30,000. That's money that people owe me that I plan on collecting within the next 12 months. Now, my business has no inventory, but we see here that this company does have inventory. And when we have inventory, we don't want to have to do an inventory reduction sale. We don't, oh, did I forget to record it? No, I didn't. I was going to say, because we wouldn't get our margin. So one thing we need to be able to know is what is the quick assets? And as a business, we don't want to have to sell off our inventory because that will affect our margin. And so the quick assets, now when they ask these questions on the test, they can say, which of the following best describes quick assets? Or they might say, current assets minus inventory can best be described as. So, these are usually like recognition kind of questions. And here, this would be the current assets minus the current, the inventory. Minus inventory. Now, on a bad draw, what I mean by a bad draw, I guess it's all, relevant, I guess. Every once in a while I get like a CPA in class, they go, gee, Steen, give me a bunch of these. I said, okay, well, maybe you got a few points here. But our current assets here are for $40 million. So boom. And so we take the $40 million and we take out the inventory, because again, what we don't want to have to do is sell off our inventory to pay our bills. So minus the inventory, boom, means we have quick assets of 20 million. Anybody know, based on pre-study, why that is important? Anybody know? Chat is open, or you can unmute yourself. By the way, you guys are welcome to record too. If you want to record this for your own purposes, that's fine with me. But everybody know why the quick assets is something that we need to know?
For the quick asset ratio.
Right on, Philip. Where we're heading is to what are called the quick or acid test ratio. Acid test. How liquid are you really? Right, as I said, because you don't want to have to do your, sell your inventory off, right? Okay, so that's our current assets. We're continuing down. Fixed assets are things we don't plan on turning to cash within 12 months. Please note the asset side of Dean's balance sheet hasn't changed. The asset side of Dean's balance sheet hasn't changed. But I'm coming to you from my off-grid studio. I bought a bunch of acreage out here in northern Arizona. I built a cabin. I built this studio. I haven't added up all the money yet because, I'm going to be embarrassed how much I've spent. Let's call it 300 grand. So I turned $300,000 in cash into this long-term asset. Are we clear? I haven't affected my net worth. I had 300. I still have 300. It's just, it's not cash anymore. I've turned it into an illiquid investment. The net worth side of my balance sheet hasn't changed. Land, total fixed assets, intangibles are goodwill. This came up in social media today. What is this thing called intangibles or goodwill? I brought up, as intangible goodwills, the Series 7 Guru. What is that worth? I don't know. That's my social media handle. It's worth something, and depending on what I assign a valuation to, that could affect my net worth, right? Some days I wake up and maybe I think it's worth $1 million. Other days I wake up and maybe it's not worth anything. To be conservative, I would value that at zero. I think, I'm dating myself again, but as an older man, what are the golden arches worth? I see a golden arches, I go, oh, that's a McDonald's. Now, do I think they make the best burgers in the land? I do not. But I do know what to expect, right? Dean will never eat a Hydrox cookie. Never will I eat a Hydrox cookie. I only eat Oreos, as you can see from my slim figure. That's worth something, right? So that's, goodwill is your reputation, your patents, your brand, whatever that is. I just saw an interesting discussion with the CEO of In-N-Out Burger. The Snyder family controls it. They're privately held. And I thought this was an interesting discussion. I certainly wouldn't expect the CEO of McDonald's to say this. And I always think it's easier to be gracious when you already have a couple $1 billion. But she said that they have decided not to pass through the inflation to the customers of In-N-Out Burger. And it's affecting their margin. But she said, it's important to us that we don't lose customers. We want them to continue to come have lunch and dinner with us. And at some point, and I was thinking, doesn't seem like McDonald's was worried about that. I mean, I went in with mom and it was like $20-something. I'm like, oh my goodness, right? So there's our total assets. Let's go over the other side now. Let's look at your current liabilities, whether it's a corporation that we're looking at or yourself. These are things you need to pay within the next 12 months. So accounts payable, wages, your employees, your taxes payable. And so we have current liabilities of 10 million. So one balance sheet calculation you're held accountable for, test question, is working capital. Now, this is important because some businesses require huge amounts of working capital. Like building cars, that takes a lot of money. Even Tesla's saying we're sucking it up right now, trying to come up with the capital. Working capital, test question, is current assets minus current liabilities. And so as we see here, we have current assets of 40 million. There's our current assets. And we have current liabilities of 10 million. And so our working capital is 30 million. Now, again, how do we test on this? Well, we either do it through recognition or practical application. Let me give you some test phraseology here. Working capital can best be described as A, B, C, D, and you come up with current assets minus current liabilities. Or current assets minus current liabilities can best be described as A, B, C, D. You come up with working capital. So either recognition or, as I mentioned, practical application. Practical application now is where I show you ledger entries, not testable, but called ledger entries. And then I ask you, what's the working capital? I would call that a more difficult draw, where I say they have cash of, they have a building of, they have accounts receivable. And then they give you the other ledger entries, and you got to figure out which ones are part of this and then come up with an answer, right? My favorite version of this on 65 and 66 is I get this all the time in debrief, that it's a client's personal balance sheet. And where do we put the sofa on the customer's balance sheet? I kind of think to myself, what a stupid question. I mean, I wouldn't even count your personal property if I were your broker. I'd say, let's not count your furniture and your Rolex. Let's just talk about other stuff. But anyways, the sofa would be a fixed asset, right? We don't plan on turning the sofa into cash within, 12 months. Now, these are what we call liquidity that we're looking at here. Liquidity. And sometimes they'll ask you, what is the effect on working capital under various circumstances? For example, if a company declares a dividend, when a company declares a dividend, it becomes a current liability. So let's say that the board declares $200,000 worth of dividends. I just made that up. And so let's see how that affects working capital. Well, we still have over here on the balance sheet, we still have 40 million in cash, or I should say 40 million, in current assets. But if the board declares this dividend, now we owe 10,200,000 because a dividend becomes a current liability. So test question, Dean has illustrated what is the effect on working capital when the board declares a dividend. And you would tell me that when the board declares a dividend, it causes working capital to decrease. It causes working capital to decrease. And, before we declare a dividend, we might want to talk to our chief financial officer and say, how liquid are we? Do we have enough to declare dividends? Some companies wouldn't declare a dividend, just depending on, what their scenario is. Now, be careful. On the payable date, that's when we're cutting the checks. Right? You should feel good paying your bills because there's no effect on your working capital when you pay your bills. When we send the dividend checks to the customers, right, we're now going to have 39.8, right? Because we just sent out checks totaling $200,000, but we also have $200,000 less in dividends. And so please note, I've just illustrated that there is no effect on working capital when we pay the dividend. So declared date, let's make a note, decreases working capital, and payable date, no effect. Yeah, when I pay my bills, it has no effect on my working capital. I have less of an asset called cash, but I have less of a liability. Right? You know, my contractor the other day said, Dean, you've been doing a lot of work around here and you got a lot of things that don't match. I said, really? He goes, you want me to paint everything to match? I said, let's do it. Right? So he painted everything and now I get a bill. Right? That bill, when I pay it, has no effect on working capital. All right. Anything, questions about working capital before we move on to our next liquidity? What we're looking at right now in the category is called liquidity. We're working our way through this balance sheet together. And before we move on, any questions on working capital? Let me give you another example of working capital question. Let's say this company sells some more bonds. They sell some more bonds. So let's say they sell $10 million worth of bonds. They issue $10 million worth of bonds. Well, that would cause working capital to go up, right? Because we're going to take the proceeds from the bonds. It doesn't have anything to do with the current liabilities, right? So the issuance of securities, and that's one of the reasons we issue securities as a corporation, is for working capital, right? So that would be another example of something that could affect working capital.
Dean, when they bring in or when they declare the dividends, do they go into like some type of a separate escrow account or something?
No. I would say, you shouldn't be an owner of the stock if you think you need an escrow account for them to make good on the dividend. I would suggest we should be doing business with people we like and trust. And, at the point you have to worry about that, maybe you should sell the stock would be what I would probably recommend. Right.
Yeah.
So, all right. So we're still working on this balance sheet here. We're working on liquidity. And another thing that we're held accountable for is called the current ratio. Oh, I'm sorry, Latonya, I see you raised your hand. You don't need to raise your hand in this setting, I don't think, unless it becomes a mess. Latonya,
Sorry, I just like to be considerate.
no worries. I appreciate
So
that.
when it comes to, I've seen questions where the current assets are impacted when you issue or declare
Yeah. Well, current assets aren't affected when you declare a dividend.
Okay.
But current assets will be affected when you pay, right? Because you're going to have less of asset called cash.
Okay.
Right.
So when I pay my dividend,
yeah,
that's when I'm going to have the effect on my working capital.
That's right. I always try, as much as possible, I try and think of this related to my own personal balance sheet, right? So, Latonya, when you pay your bills, does that affect your current assets? It sure does, because your cash goes down, right?
Right.
I kind of joke, Latonya, out here, my brother's got the 5 acres next to me. And I told him the bank of Big Brother is open. I mean, why would you want to borrow money from a bank, Chris? I mean, because they might come take your stuff. I'm not going to come take your stuff. So, but I had to remind my brother that I don't have unlimited reserves. So it's not like, I don't know what the number is, but at some point I'm going to have to say, well, I'm sorry, I don't have that much working capital, right? So I just told you my contractor, he likes me because I pay quickly. I mean, I try to pay quickly if I owe people money, but right, that's cash that is out of there now, right? That cash is no longer in my bank account. All right.
Thank you.
Now, the other thing I always tell people, if you've been with me a while, is that if you can't decide what to do, you should do division. So if you're struggling about what math to perform, I would suggest dividing. And if you can't decide what to divide, take the first number and divide it by the second number. And the next thing in liquidity, because a lot of times it's going to be like A, B, C. And so we've already talked about working capital. And maybe our B choice on the test is the current ratio. Depending on what they're asking you, will depend on what the answer is. And so current ratio is going to be the current assets divided by the current liabilities. Right? And that equals our current ratio. I kind of joke on this one, Latonya, if I get less than 1-to-1, I better get my button gear because I'm going to have a severe liquidity crisis, right? Right. So, 4-to-1 is pretty damn good. So here we have 40 million in current assets. And we have 10 million in current liabilities. And so here we have 4-1. Now, again, the way, how do we test you on this? Well, we can either test you with what I call recognition. What I mean by recognition is current ratio can best be described as, and you come up with current assets divided by current liabilities, or I say current assets divided by current liabilities can best be described as, and you come up with current ratio, right? That answer said I'm working on the other side. Now, remember, the other thing I can make you do is actually do it. Give you some ledger entries and ask you to do the perform on this. Now, I really think that most people, 7, this is lower key than it is 65, 66. It can still be testable on 7. It's just a lower probability. 65, 66, they do get into more in-depth on the balance sheets. But this is in the same section as some of the other math is. And so it's more likely you're going to get 2, 3, 4 balance sheet questions than you're going to get 2 or 3 internal rate of return questions, right? So if you're struggling with like discounted cash flow and internal rates of return and present and future value, I would suggest, man, maybe doubling down on balance sheets, saying, well, this is arithmetic that I can do, and I'm going to get all these I'm entitled to. All right, well, remember what we said we don't want to do? We don't want to have to sell our inventory to pay our bills, right? Because if we are compelled to sell our inventory in an inventory reduction sale, we might not get the margin that we would like. And so let's do this again and assume that we're not going to count the inventory. And again, I said there's a couple ways to test on this. One way to test on this is just to ask you which best describes or, and then actually do practical application. So the quick asset or asset test ratio is where we take the quick assets and we divide by the current liabilities. And we see what that looks like. And boom, let's call this, let's put that there. And again, how do we test on this? We test on this by either saying what best describes the asset test or quick ratio, and you come up with quick assets divided by current liabilities. Or we'll say what best describes quick assets divided by current liabilities. And you would say the asset test ratio. So here we have 20 million in quick assets. Remember, that was the current assets minus the inventory. So here we have 20 million in quick assets. Remember, that means there might be an intermediate step you have to do here to get this one right. Boom. And we're going to divide. And that is 2-1. Pretty damn good. Every industry is different, by the way, about, how much, cash you need to run things, right? I go into businesses and I go, whoo, it takes a lot of money to be doing this, right? A balance sheet, again, is a competitive thing. It's a competitive thing. And, right now, right? NVIDIA, it's got 3 trillion in market cap, but they should be concerned because their margins are so rich that there are people lining up to take them on. And the people lining up to take them on are companies like Google, Microsoft, Apple, who all have the kind of resources to actually do that, right? They may not be successful, but they could do it. All right, so we have our asset test ratio. So those are some liquidity things we're interested in. And so now we need to talk about how do we capitalize a business? Capitalization. The capitalization of a corporation consists of 2 things. It consists of equity and debt. There's no such thing as a corporation that does not have common stock. right? There's no such thing as a corporation that doesn't have common stock. There's our common stock right down there. You know, par, remember, for bonds is 1,000. Par for preferred is 100. And par for common stock is $1. And so that's important because that means we issued originally 1 million shares. And there is no such thing as a corporation that hasn't issued common stock. Now, if here we see the corporation has further decided to capitalize their business by selling preferred stock, and they've also sold some bonds. So the capital consists of equity and debt. That alone could be a test question. You know, capitalization consists of which of the following? And you'd say it consists of stocks and bonds. So here, let's look at our long-term liabilities. And we have 8%. Remember this from your earlier exams? That's 8%. That's called the coupon, the nominal yield, or fixed or stated rate of return. That's what that's called. Whoop, I didn't mean to do that. Let's put some of that back. So here we've told these bondholders, ABC Corp, that at maturity or anytime, but usually at maturity, we're going to say, what do you want? Do you want your $50 million back, par, or do you want X number of shares of our stock? You know, so if you own these bonds and it's 20 years, it's maturity, I say, what do you want to do here? Do you want to exchange it for the stock, or do you want your $1,000 back? And it depends on what the current market price of the stock is. So one thing we need to know is what's called the conversion ratio. Whenever you are given a conversion price, you need to establish a conversion ratio. When given the conversion price, you need to establish the conversion ratio. Does anybody recall how to do that from their previous exams?
Take par and divide it by the price of the conversion.
Right on, Philip. So that's what we're going to do. We're going to take par, which is 1,000, and we're going to divide that by the conversion price. And then remember, we said if you can't decide what to do, you know, you should always divide. So I had a guy who, you know, he was taking his 66, and, you know, he bought tutoring, and, you know, I hit the Zoom link, and he shows up. He goes, Dean, I'm not paying you $225 an hour to do math with me. He says, you know, I can do math. You give me any two numbers, I can solve for the third. And so let's just skip that. I said, fine, you know. Good news, he passed, but he said, Dean, you know, I told you I was a math guy, but, you know, I kind of struggled a little bit because they were asking me to recognize things, not so much to do the math. And so I struggled a little bit. I was able to kind of reverse engineer, but I wish I would have spent a little more time perhaps on, you know, just being able to recognize things and pull it out of the lineup, so to speak. And so now we find out, let's get our calculator here and figure out what we're going to say to you as a bondholder at maturity. So at maturity, you can convert anytime you want. But at maturity, the issuer is going to say, do you want, you want 1,000 divided by 50? Do you want 20 shares of our stock? Or would you like your $1,000 back? And if the 20 shares is worth more than the $1,000, I'm going to say, give me the stock. And if the stock is worth less than that, I'm going to say, give me my $1,000 back. So, you know, we know what you're going to say based on where the stock is. Now, this is kind of important too, because we know that we have a potential as existing owners to be diluted. We know that, you know, there's going to be these bondholders that may decide that they want some stock. right? By the way, we were able to borrow the money for a lower interest rate there because of that conversion feature. All right, so we now we want to figure out, as again, we're doing valuations here, we're doing fundamental analysis. We want to know, what is the potential dilution? What is the potential dilution if these new owners join us? Right? I was just thinking of the market cap of Microsoft being $3 trillion. And Bill Gates, for many years, owned 25% of Microsoft, but then he decided to diversify. He would have been better not to diversify, right? But he only owned 25%. At one point, he owned 100%. But right as Microsoft sold more and more stock and convertible bonds, he got diluted. You know, Howard Schultz owned 100% of Starbucks when it was 8 stores. Now he owns like 4% of Starbucks because he's been massively diluted. All right, so how are we going to figure out how many shares can be issued as a result of these people converting? So how are we going to figure out how many shares this represents as potential dilution? We're going to take the $50 million and we're going to divide by par, right? Because that will tell us how many bonds there are. So let's put that over here. And so when we do that, 50 million divide by 1,000, we find out there's 50,000 bonds. And each of these bonds represent how many shares potentially? There's 50,000 bonds, and each of them represents the potential issuance of how many shares per bond?
20.
Yeah, so we're going to take the 50,000 times 20 shares, and we find out this represents the potential issuance. 50,000 times 20, a potential of another, I'm just making sure I'm doing the arithmetic right, times 20. Yeah, it looks like another 1 million shares there, potentially, right? But that, by the way, it's not all bad, right? Because that means if the people take the stock, we don't have to pay back the borrowed funds. You know, I saw a CEO being interviewed one time, and he had a lot of debt on his balance sheet, and everybody's worried about how he's going to pay it back. And he said, I'm not going to have to pay it back. And we said, well, say it ain't so. And he said, no, it's all convertible, and I'm just going to make damn sure that at maturity, people say, give me the stock. Now, please note, in terms of capitalization, you can see here on the balance sheet, and you should know that the bonds are senior to the preferred and to the common. Remember, they come ahead in liquidation. Now, before I move on to the equity component of the balance sheet, is there any questions here? Let's put our bond money down here. So we have 50 million in bonds. Let's put that there.
The dilution calculation, Dean, I have not seen that yet in the Q Bank for the 65.
No, that's just me. A good question, Phil. But always ask me if Dean's just going down a, you know, let's call it this way.
No,
Philip,
it's good.
for your
Yeah.
edification, right?
It's
I would know,
knowledge.
but when in doubt, I always ask me, right? But conversion ratio, you should definitely know that.
Okay.
Right. So yeah, but always, you know, say, hey, Dean, you know, so I'd be worried about that.
Thank you.
All right. So preferred stock, I always get this from people all the time, and I don't know what to make of it. People say, Dean, I got more preferred stock questions than I was expecting. I always respond, well, I don't know. What were you expecting? Right. So, do you remember a couple of test points about this preferred stock? There's $20 million worth of preferred stock here. And remember, preferred stock has preferential treatment in 2 areas. Do you recall the 2 areas in which the preferred stock has preferential treatment?
Yeah, in the order of liquidation, they're above the
Right on.
common stock.
Right on. They are senior to the common. Right on. What else?
Oh, what else? Do they have a preemptive? No, not preemptive.
No.
Um, What else do they have? Oh, they get a higher dividend?
Well, not that depends. It depends. They have preferential treatment in two areas: dividends and liquidation. We cannot pay a dividend to common if we're in arrears to our preferred stockholders. So, Latanya, that's going to be important because remember, we're going to declare a dividend perhaps. And before we declare a dividend, I'm going to say, well, how much earnings do we have available to common? You go, geez, Dean, what the heck does that mean? I said, well, remember, all of our earnings, Latanya, aren't available to our common stockholders because we first got to take care of our what?
Preferred.
We got to pay them, right? So before we start
first.
Yeah, before we decide we're going to pay ourselves a dividend or distribution as a common stockholder, we got to take care of our preferred. I think of it the same way, Latanya. We got to take care of our preferred if we liquidate too. If we decide to sell off all the assets and pay off all the liabilities and call it a day, well, we're going to have to take care of those preferred stockholders first, right? So indeed, an important there. Okay, we have our common stock. Here you can see that we have capital in excess of par. What the heck does that mean? What that means is we sold this common stock for $5 a share. $5 a share. $1 of the 5 represents par. And then the other 4 is what we call paid in surplus or capital in excess of par. I wouldn't worry about that at all. So that Philip hasn't asked me yet, but I wouldn't worry about that at all. Now, when the board gets together, Latanya, and we decide what to do with our earnings available to common, we might decide to retain all of the earnings and not distribute any of it to our shareholders. We might decide to distribute some and, keep some to build the business. And so that retained earnings is the earnings we did not distribute to the owners. It's money we kept to build the business, right? Now, if we're a growing business, we would expect that our board probably wouldn't declare us a dividend, that whatever money they're making, they're going to keep to build the business and say, Latanya, we have no dividends. So we're building the business. And if you want to go along for the ride, what you're after is price appreciation because our company pays no dividends. You were here recently, Intel has said no dividends until further notice. They said they're building all kinds of chip factories and capital expenditures, and they're keeping all the money. Right. So we'll talk about that in another discussion in just a little bit. All right. So now we have a total net worth of 40 million. And so here that represents the equity in the corporation, that 40 million. So let's put that over here. And we call this test question total capitalization. Total capitalization. How much do we have in net worth? Plus what do we have in our bonds? And that's called total capitalization. So I say, what is the total capitalization? I'm asking how much bond money and stock money is involved in this business. If we're trying to compete, we might want to know how much money we need, right? Oh, geez, let me fix that. I told you, like, building cars requires a lot of money. Let's say that Dean decides that I want to take on STC and I want to take on Past Perfect and I want to take on Knopman and Kaplan. Is that going to take a little more capital than Dean presently has?
Yes.
Yeah, right. So, Philip, maybe I'm going to set up a C Corp. Guru Exam Prep is an LLC. So that means, Philip, I just want the money to flow through to me.
Yeah, you can hire me.
There you go. Right there you go. Right. Watch out, world. Here we come. Right. So, okay. So, we now need to talk about solvency. So again, I think the best way to think about this is your personal situation. I say, Philip, how did you capitalize the purchase of your home? How did you capitalize the purchase of your home?
Borrowed.
Well, I would imagine you have some equity in the home and some debt, right? And again, it would depend on person to person about how aggressive you want to be in capitalizing the purchase of the home. Some people like to put it down a big down payment so they can borrow less. Some people like to put down a little down payment and they like to borrow more. I know some people like to put down no down payment, all leverage. I know some people like to pay cash. This is just a kind of a strategic choice we make about how to lever the business, how much leverage we want in the business. Now, leverage is risk because the same financial speed we're going to make money with is the same financial speed we're going to lose money with. And so we want to know, what is our debt to total capital? Our debt, long-term debt to total capital. What is the leverage in the business? This is about solvency. And I kind of joke about this one. I mean, solvency is going out of business. Recently Toys R Us went out of business, Chapter 7 liquidation. And I'd be the first to admit that selling toys is difficult, particularly against Walmart and Amazon, who have huge amounts of capital compared to Toys R Us. Yeah, but it didn't help that they had borrowed billions of dollars, that they had billions of dollars of debt on their balance sheet. And that means they have less flexibility. That means they got to sell more toys. And so here, if we look at our corporation that we're doing our valuation on, we've got $50 million in bond money. And we got total capitalization of 90 million. And so if we do that math, we find out that 55 cents of every dollar debt to total capital belongs to our bondholders and not our shareholders. And again, it's just, this idea of leverage. There are some industries that use large amounts of leverage. For example, utility companies use large amounts of debt on their balance sheet. They have a small amount of equity on their balance sheet, a large amount of debt. So in my example with Philip, right, if Philip tells me, Dean, I capitalized the purchase of my home with a very small down payment and a large mortgage. I said, woo. He said, Dean, I put down 5%. I borrowed 95%. If my home goes up 5%, I've doubled my money. I said, well, that's true. But if the house goes down 5%, you're what?
Underwater.
You're right on, right? So it's just choices that we may make. But if you are leveraged again, you're going to be more susceptible to interest rate risk, right? So Philip further tells me, I'm just making this, so I know nothing about Philip's financials, but he says, Dean, yeah, I got this teaser kind of mortgage thing where they gave me I borrowed all the money for my house at 2%, but it resets this year. I say, uh-oh, right? So you're going to be more sensitive to interest rates if you have more debt on your balance sheet. How do we test you on that? We test you on that with a question about like a utility company or something like that has a large amount of debt on their balance sheet. And we test you on two things. It's counterintuitive, but that's called trading on equity. When you're on your balance sheet, you have a small amount of equity and a large amount of debt. I think it would be the other way, but it's called trading on equity. And then we ask you to recognize that you would be most sensitive to interest rates. All right, let's put this all together in a more pretty way. So here we're going to now do this in a pretty way. Again, we're doing valuation. You're going to get tested on book value, market value, and par value. A par value, if that's what they're asking, that's an arbitrary number we use to set up the books. And arbitrarily, test question for bonds, it's 1,000. For preferred stock, it's 100. Do you remember what it was for common stock?
$1.
Yeah, and then Trevor, the other thing we get tested on is market value. Woohoo! Man, we got what, $3 trillion companies now? Wow, Microsoft, Apple, NVIDIA. If we took their price of their stock and multiplied it, that would be their market cap. And you do get tested on that. The benchmark or index for large caps is the S&P 500. That is a test question. Maybe we're going to have to come up with a new index, mega cap, or maybe a new index, like Magnificent 7, right? Whatever the case may be. Now, I'm not going to ask you to calculate book value, but I am going to ask you to recognize that it's the theoretical liquidation value of the corporation. Theoretical, because we don't assume we're going to do what with the corporation, liquidate it, right? But theoretically, if we decided one day to call it quits, I joke, capitalism without failure is kind of like religion without hell. what would that look like? And again, the reason this is important, because if I'm a value investor, test question, a value investor, I'm looking through fundamental analysis to get a margin of safety. And I'd like to be able to buy this stock for as close to book value as possible. Kind of an old-fashioned idea. If I'm a growth guy, I don't care at all about this. As a growth guy, I go, what do I care about the book value NVIDIA? What I care about is their arms merchant to the AI industry, and it's a secular growth opportunity. That's an entirely different kind of a thesis, right? So net worth, $40 million. We said we got to take care of our preferred stockholders, right? They have preferential treatment and liquidation. We're going to be conservative here and say that the goodwill, we're going to back it back out of there, because what is that brand worth? I couldn't believe that when they sold Bed Bath & Beyond in liquidation, bankruptcy, that Overstock was able to buy the entire brand for $5 million. I thought, wow, how clever. The next day, Overstock was disappeared and everything was Bed Bath & Beyond. That really isn't Bed Bath & Beyond online. It's Overstock. They had bought the brand. And I thought that brand would be worth more than that, but what do I know? You know, what is Jeffrey the giraffe at Toys R Us worth? You know, these are intangibles. We're going to back that out. Then we get our book value. And then remember, how did we determine how many shares there were? Common stock, dollar par value, boom. Am I going to make you on your test come up with $15? I'm not. What I want you to know is that's the theoretical liquidation value of the business. And if you're a fundamentalist, that is one of the metrics you'd be looking for in terms of valuation. Right? There's others, some of the parts, you know, discounted cash flow, there's others, but that's what. We did this one. Working capital, very testable. We said it was the current assets minus the current liabilities. We talked about things that would affect working capital. We did the current ratio. We said it was 4-to-1. We did the quick ratio. Now remember, the quick ratio, we had an intermediate step where we had to figure out what that was. And we said these would all be A, B, C, D questions, right? What best describes working capital, or working capital can best be described as. So, you know, let's call that choice A. Let's call this choice B. Let's call this choice C. And these were all about liquidity. And then we talked about solvencies. Those are different things. Solvency means, you know, to say I'm not liquid, again, my friends don't get this. I said, I'm not very liquid right now. And, you know, they start picking up my bar tabs for me. I go, what is going on? And, you know, they said, well, Dean, we heard you're having financial difficulties. I go, no, no. I could, if I wanted to, take care of my liquidity problem very quickly by turning a long-term asset into a current asset. I'm just not going to do it. So, you know, listen, you don't need to take care of me. I'm fine. You know, but, you know, well, we talked about this one. Any questions on these before we move on and talk about another component of the financial statements? So we've talked about the balance sheet. And so the next thing we're going to be discussing is the income statement. We did that there, boom. Earnings per share. Now, I'm not going to make you come up with earnings per share, but I am going to ask you to come up with the PE ratio. I'm going to ask you to come up with dividend payout ratio, mainly recognition, but I may ask you to do it. All right, so that's kind of where we're at. All right, so to do the earnings per share, we need a income statement. So how often do public companies report their what we're discussing? How often does a public company provide a balance sheet and an income statement to the SEC, to its shareholders, and to the market center in which it trades?
Semi-annual?
Nope.
Once a quarter.
Quarterly?
Yeah, quarterly. Yeah, right. We do 3 10Qs. We do three 10Qs and a 10K. The 10K is that fourth quarter and the annualized results. And that 10K is going to be audited. So on the quarterly results, we'll take the chief financial officer's word for it. So here, you probably heard of this phraseology before. Let's see, have you heard of this phraseology before? You say, Dean, what is your top line at Guru Exam Prep? What is your top line? And Dean, what is your bottom line? Right, the top line is revenue, right? And so here we have 87 million in revenue. Cost of goods sold, 20 million. 10 million in operating costs, so we have 57 million. That's pretty good margin. Pretty good margin. Oh my goodness, ladies and gentlemen. What was I thinking? You know, my clients and I financed a brasserie. And the margins in the restaurant industry are so terrible. I mean, every day I go to that restaurant, I'm going, oh my God. It was the employees used to make fun of me because they'd say, Dean, why are you pushing the Cajun catfish all the time? The blackened Cajun catfish. I go, do you know what the margin is on our Cajun blackened catfish? We sell that thing for like 25 bucks and it costs us like $3. So everybody sell the Cajun catfish. You know, our steaks are good too, but we don't have the margin. The margin is what we need. So here we have 57 million operating profit. I told you NVIDIA is killing it, right? But they don't even make those chips. Their margins are huge. They're huge. Earnings before interest and taxes. We got to pay our bondholders. Remember our bondholders? So we owe them $5 million. Please note the interest expense is deductible. That's before we pay taxes. So again, way beyond, again, Philip, the test itself. But if I were a banker and we're looking to finance this corporation, ABC, we might want to look at what are the advantages of bonds versus equity. And one of the advantages to bonds, Philip, is if we issue bonds, we don't dilute your existing owners. Right. And, you know, your owners are going to get upset if you continue to issue equity because they're going to get diluted. Another advantage to the bonds is that we're paying the interest before we're paying taxes. So we have taxable income here of 52 million. We pay our taxes. We have net income. Now, remember this, Latanya? We said we have to take care of our preferred stockholders before we can pay a dividend to common. All right. So we take care of them. There's our 800,000. And now the board has available to our common stockholders 34,200,000. And now we're going to decide how much we're going to distribute that to our shareholders, if any. If any, remember, very testable. You don't have a right to a dividend. No, 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 no. You only have a right to a dividend if the board what?
Elects to pay it.
That's right. Declares it, right?
Declare.
I think this company here is being pretty stingy, Philip. I mean, that's pretty stingy that they're made 34.2 and they're only going to send us $1 million. Now, we would expect, again, very testable on 65, 66, that if I'm a, it's a growth stock, they'd have little or no dividend. Right. So this company has to make a pretty good argument to us, Philip, as shareholders, that it's better for them to keep the 33,200,000 than it is to send it to us. Right. I mean, you know, at some point we're going to say, do you really need that? I mean, when Stephen Jobs was around, Apple never paid dividends and never bought back treasury stock. And then when he died, Tim Cook said, okay, maybe we don't need 400 billion in cash laying around. So we're going to start distributing excess capital to Apple shareholders through dividends and share repurchases. Right? We would expect NVIDIA to be doing that. We would expect it to be a mature, stable company. Now, remember what we're trying to get to here is the earnings per share. And so now that we have our income statement, we can revisit this earnings per share. And remember how many shares we had outstanding? You remember how many shares we had outstanding?
1 million.
Yeah, there you go, right? There's that million. Well, and so now we're back in business. Now, I'm not going to make you come up with the $34.20. I'm not going to make you come up with that on the exam. But now the next things we're talking about are very testable. The PE ratio, the dividend payout ratio. And again, this is going to be important is in terms of valuation, because we use the PE as a multiple. You know, I'm not a banker anymore, but you know, if I was going to take In-N-Out Burger public, I'd say, listen, the PE multiple in the fast food industry is 18-1. I think I should be able to get you something close to that, maybe even a premium, because I think you're better than McDonald's, but what, you know, or Chick-fil-A privately held, right? What's the multiple for that? Kohler's privately held. They make beautiful bathroom fixtures, again, ridiculous, but in my cabin here off grid, I have a Kohler fixtures. And my contractor here was making fun of me because he goes, Dean, it's a cabin. It's not a mansion. I go, hey, when it comes to a a bathroom. I want a nice one, you know. So that's how we also use it to make comparisons between companies in the same industry. You know, maybe we just, as a value investor, say, hey, I like this company because it has a lower PE, or I like this one because it has a higher PE and it has growth potential. And again, it's testable to know that value investors would be more attracted to a lower PE ratio, whereas because of the growth opportunity, growth investors would be acceptable for them to have a higher PE because they assume the earnings are going to double or triple or whatever they're going to do. All right, so now we give you the current market value. That is very much a test question. Very much you're going to have to be able to calculate price to earnings. So again, if you can't decide what to do, you divide. And so here it's 4, 10, 40 given information, earnings per share given information, and we come up with a PE ratio of 12-1. I don't know of any draw where you're not going to get asked on that. I'm wishing for all of you a dream draw. Everything you studied shows up. You know, but every once in a while you get to, you know, face a death draw. I'm not going to make you do price to book, but remember, this is a part of fundamental analysis. And what we mean by this is that we're looking and doing valuation fundamental analysis of a margin of safety. And so, for example, like banks trade more closely to their price to book than do other things. Kind of makes sense because the bank, you know, if we have to shut down the bank, it's, you know, book value would be important. And there's other businesses where this is a metric that nobody cares about. You know, I was just joking, like AI, nobody would care at all about price to book. All right, woohoo. Now, one more thing I want to discuss with you is based on this earnings per share and what we call the dividend payout ratio. You know, I thought this was pretty interesting that this guy was taking over as CEO of the company. And he said, listen, if I take over, I just don't want to be a steward of this company. I want to grow the company. And I know I'm not going to be very popular because you guys have been paying out so much of your dividends as earnings that there's no money left to build the business. So moving forward, he says, I think what would be fair is a 50% dividend payout ratio as a dividend payout policy. So if we make 34.20, you would expect that we will pay you half of that. You know, this varies. And again, they might ask you to crunch this on the test. So if I take 34.20 times 50%, that would be $17.10. So I say a company has an annual dividend of $17.10 and has earnings per share. You know, I'm making this up, you know, whatever the case may be. And then remember, the higher it is, the more mature, stable business we think it is. And it has earnings per share, in our example, of 34.20. And then I ask you on the test, what is the dividend payout ratio? And we take 1710. And we divide that. We always divide it. We can't decide what to do. And we come up with a dividend payout ratio of 50%. And again, that would be recognition on the test that this is more likely a mature, stable business because mature, stable businesses pay out a larger portion of their earnings as dividends. You know, I had a young lady that I was dating, and, you know, we got into it a little bit. And I said to her, I said, listen, there's zero growth opportunity in me. That other guy is a serious growth opportunity. If, you know, he gets that drug thing beat, he gets out of jail, he's got nothing but upside. But that ain't me. You know, so you got to decide. You have selection risk. You got to pick him or you got to pick me. And, oh my God, she got so mad at me. She goes, you know, that's the problem with you. Everything's an investment. I go, well, you know, I think relationships are investments and not all investments work out. And, what can I tell you? And she goes, well, what if you were jail? Wouldn't you want me to help you? I go, I don't know why I would be in jail, but I would probably call my attorney if that was the case. Right. So, you know, we got to decide what your risk tolerance is when buying common stock. All common stock has risk, but based on fundamental analysis, we're trying to mitigate some of that risk. All right. Well, that concludes our evening. Is there anything else that you guys would like to talk about as it relates to this discussion?
I had a question.
Yeah, what do you got, Matt?
So if a dividend is declared, the current liabilities go up,
Yep, causing working capital to go down.
and then the current assets are unchanged.
That's right. That's why your working capital decreased. You have
And
the
then
same
if it's-
cash.
And then if it's paid,
That's right.
current assets go down, current liabilities go down.
It's a wash. It's a dollar for dollar match, right? So I
working
joke. If you
capital
go,
unchanged.
I always think if I go to my mailbox and there's a new bill, I go to my mailbox, there's a new bill, my working capital goes down. A bill that I was getting, right? When I pay my bill, no effect, right? Because I have less of an asset in my checking account, debit, right? And I got the liability, it's a wash. So declared dividend, working capital decreases, declared date, payable date, no effect. No effect. Right? Anything else? Does that make sense to you? Want me to put one on the screen? Let me just give it screen
So
here.
you said when you pay your bills, there's no effect on working capital?
Yeah, because you got less of an asset called cash. Can you guys see my screen?
Yes.
All right. So here was our working capital we were working with this evening. So I'm just putting that back on the board. Here's our $40 million in current assets. Boom. That was on that side of the balance sheet. And on this side of the balance sheet, we had $10 million in liabilities. Boom. And we'll put that in red. Boom. And so this is current assets. We'll put that in green. We'll put this in red. And so our first test question there, Matt, was what is the working capital of this corporation? And it's 30 million. You with me on that?
Yes.
Okay, so now let's say I'll just make up a date. Let's say that on September 1st, the board declares, it's called the declared date, $200,000 in dividends. And we said that when they could declare dividends, it becomes a current liability, right? So we now have 10 million two in current liabilities.
Working capital goes down.
Yeah, it's now what, 29.8? Am I doing that arithmetic correct? Right. This would be, again, Matt, what we're doing here is we're taking the current assets minus the current liabilities just went up. Okay, now let's say that the payable date is October 1st. So now I'm going to put the payable date up there. We're going to send out the checks to the shareholders. So payable date, I'll say is October 1st. And that's when we're going to send out the checks. And so now our cash goes down 39.8 because we just sent out dividend checks, right? But so did our liabilities. Our liabilities go down, right? It was 29.8 and it's still 29.8. There's no effect when we actually pay the dividend. Does that make sense, Matt?
It does. Thanks for the graph there.
You bet. You bet. All right. Anything else?
Fascinating.
Well, yeah, it's not for everybody. Phil, to be honest with you, I was employed without any understanding of accounting for a long time. And I was so embarrassed when the lights finally went on to tell everybody, I finally get it. I've been doing it for a while, and hey, I didn't know what the hell I was doing, but now I do. So pretty embarrassed. I feel pretty honored. I used to teach a business board simulation where we teach accounting to non-accountants. I thought it was kind of fun because I was the only guy who wasn't a CPA, and it was fun. But people would, in this business simulation, that you would just say, "Oh my goodness, I hope these people are never really around the real money," because they were trying to do things that you just can't. Where do the retained earnings go? That's not cash, right? So it can be fun, I guess, is what I'm saying. It can be challenging, and again, it can be a competitive issue, right? So I mean, for us, it's about passing the test. But after you pass the test, the better you handle an investment. I always just say, right, if you can't have the events managing you, you got to manage the events, and the more control you have of the financing of things, the better, more control you have over the business, right? If you know, and the more flexibility, I should say, you have, as I mentioned, I was teasing Philip, right? The more leverage, the less flexibility you have. You know, and the more finance, you know, resources you have, the more flexibility you have. All right. Anything else for tonight?
Hey,
Now,
Dean, you said
yeah, Matt.
you said you recorded this. Will we be able to rehear it?
Sure, absolutely, absolutely. So it'll be available as a class replay or available to you guys privately. If you want it early, just let me know and I'll send you the link that'll let you watch it before it actually goes live on the channel. And then remember too, you also, for participating, you get access to the free office hour. Are you guys aware of the free office hours that you get with the classes?
No, I didn't know that. That's
Yeah, so if
excellent.
you go back to the booking page, Latanya, you'll see there's an office hour for paid students. So I cap it at 5 because, you know, what do we have here? 7. I'll make exceptions if it's a, you know, if there's a 6th person, I'll probably let them in. But that's free. And then we also have a free live stream that we do, not every Tuesday, but some Tuesdays. And you're now eligible to participate in that as well. Anybody can participate in that. But all right, anything else for tonight?
And do you
Yeah,
post that on
Dean.
your, I'm
Yep.
sorry, do you post that
No worries.
on your website?
Yeah, it's on the booking page. Just go to classes where you like you registered here, Latanya.
Mm-hmm.
Just go right there and you'll see office hour, and it won't charge you though. You'll just be able to register for it.
Okay, thank you.
You bet. What else? Trevor, you had something?
Yeah, Dean, pleasure meeting you. So Matt had my first question was the replay, so we got that, right?
Yeah.
And the second question was the office hours. So when we do the office hour, I'm assuming that might be something where we just want to go over a question or a subject.
Yeah,
maybe
it's
say,
exactly
"Hey,
what it
Dean."
does. It's exactly what it is. I just open up chat, first come, first serve, for whatever exam. Sometimes it works out that everybody's taking the same exam. Sometimes it doesn't work out that way, but I mean, so yeah, it's just a free form kind of thing, right? It's not an organized lecture. It's just like, hey, can you talk about CAPM, or can you talk about modern portfolio theory, or can you talk about margin and whatever? And then I just work my way through it in the chat. It's an hour, so I do, you know, it's a little truncated. It's not going to be if somebody says, how does the universe work? We're probably not going to be able to get it done in an hour, right? If somebody says, hey, Dean, can you go over like SMA or something? Maybe we can get that done in the office hour. Anything else for tonight? Okay, well, remember, inch by inch, financial fundamentals, fundamental analysis is a cinch. Yard by yard, fundamental analysis is hard. And I'll see you in the free office hour. See you on the live stream. I'll see you when I see you.
Thanks,
All right.
Dean. Have a
My
good
pleasure,
night.
guys. Bye-bye.
Thanks. Bye.
And Sandy, are you still there, Sandy? Oh, I was going to say, I know I have Sandy on the calendar.